Understanding the debt-to-equity D/E ratio in fundamental analysis. How much debt is too much for a company? What is the debt-to-equity ratio? The debt-to-equity D/E ratio measures how much debt a company is using compared to the money invested by its shareholders. It shows how leveraged a company is and how financially stable it might be. Formula: D/E ratio equals total debt / shareholders' equity. Total debt includes long-term and short-term borrowings. Shareholders' equity includes share capital plus retained earnings. Why is the D/E ratio important? Tells you how risky or conservative a company is with debt. Indicates financial health. Companies with lower debt can survive tough times better. Helps assess a firm's capacity to take on more loans or pay dividends. Think of it as a measure of balance between borrowed money and owner's money. Example calculation: Company A. Total debt, 400 Indian rupees crore. Shareholders' equity, 800 Indian rupees crore. D/E equals 400 Indian rupees / 800 Indian rupees equals 0.5. This means Company A has 0.50 Indian rupees in debt for every 1 Indian rupee of equity, a relatively safe level. Company B. Total debt, 1,500 Indian rupees crore. Shareholders' equity, 500 Indian rupees crore. D/E equals 1,500 Indian rupees / 500 Indian rupees equals 3.0. Here, Company B is heavily leveraged, 3 Indian rupees of debt for every 1 Indian rupee of equity, which is risky. How to interpret the D/E ratio? D/E ratio interpretation: 0. 1 low debt, financially conservative. 1. 2 moderate debt, potentially manageable. 2 high debt, risky, may face financial pressure. Always compare within the same industry. A good D/E in IT may be bad in infrastructure. Sector-wise perspective. Banks and NEFCs naturally have high D/E due to lending-based model. Infrastructure / real estate, higher D/E common due to capital-intensive projects. Tech and pharma, often low D/E as they use internal cash flows. Where to find D/E ratio? Balance sheet of annual reports. Financial websites, Screener.ai and Money Control, ticker tape. Ratios section under financials on most stock analysis platforms. When is a low D/E ratio good? During economic downturns, low debt ensures survival. Helps companies raise more funds in the future if needed. Indicates conservative and prudent management. When is a high D/E ratio acceptable? If the company has strong, stable cash flows like utilities. If it's using debt for expansion that boosts earnings faster than interest costs. If operating in a capital-intensive sector where debt is normal. Risks of high debt. Higher interest obligations, lower profits. Inability to repay, risk of default or bankruptcy. Lower credit rating, harder and costlier to borrow. Dividend cuts to preserve cash. Comparing 2 realistic examples: metric: Company A, Company B. Total debt Indian rupee 500 crore Indian rupee 2, 000 crore equity Indian rupee 1, 000 crore Indian rupee 500 CRD/E ratio 0.54.0. Conclusion: healthy balance, highly leveraged. Company A is more stable. Company B might face liquidity stress if earnings dip. Combine D/E with other ratios. To make better decisions, analyze D/E with interest coverage ratio. Can it pay interest? ROE. Is equity being used effectively? Current ratio. Short-term solvency. Operating cash flow. Cash to cover debt. Final thoughts. The debt-to-equity ratio is a critical measure of financial risk. A healthy D/E ratio suggests sustainable operations, ability to handle downturns, room to grow. Always look for a balanced approach. Too much debt is risky, but no debt might mean underutilized growth potential. Smart investors look beyond the numbers. Analyze why debt is rising, how it is being used, whether earnings are growing fast enough to support it. As Peter Lynch said, the trick is not to learn to trust numbers, but to learn what numbers to trust.